Barbara is 67 years old. She retired from the post office after 28 years. She lives in Ohio on a pension and Social Security. Every April, she hands her tax return to the same preparer she has used for 11 years, pays whatever she owes, and moves on. Last year, she owed $900 in federal income tax. She should have owed nothing. Not because she did anything wrong, not because she was cheating, but because 5 separate provisions in the tax code exist specifically to protect people in her exact situation, and not one of them was on her return. Her preparer never mentioned them. The IRS never sent her a letter. And Barbara, like millions of retirees over 65, had no idea she was leaving real money with the IRS every single year. Today, I am going to walk you through all 5 of these provisions so you know what to look for. This video is for educational purposes only and is not tax or financial advice. Please consult a qualified tax professional before making any decisions about your specific situation. My name is Nancy, and you are watching Senior USA Guide. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds useful to you, hit the subscribe button and turn on notifications so you do not miss a video. Here is what makes this list worth your time. These are not theoretical strategies. These are not things that apply only to wealthy people with complicated portfolios. These are breaks the IRS built directly into the tax code for ordinary retirees, many of them automatic once you know to look for them. And almost none of them make it onto returns filed by people who do not know they exist. Tax break number 1, the additional standard deduction for age 65 and older. This one is the most basic and the most frequently missed. When you turn 65, the IRS increases your standard deduction above and beyond what every other taxpayer receives. For the 2026 tax year, that additional amount is $2,150 for single filers and $1,650 per qualifying spouse for married couples filing jointly. If both spouses are 65 or older, that is an extra $3,300 on top of your already higher standard deduction. Most people who have a preparer filing their return receive this deduction automatically once their age is entered correctly. But the number of returns where the age box simply is not checked is higher than you might expect. If you have ever switched preparers, used new tax software, or had someone file your return in a hurry, this is worth verifying. And here is something that rarely gets mentioned. The same additional deduction applies if you are legally blind. If you are 65 and legally blind, you receive 2 separate additions to your standard deduction. They stack. For a single filer who is both 65 and blind, that is an extra $4,300 on top of the base deduction. I have seen returns where the blindness box was never checked, even when the taxpayer had a documented vision impairment. Tax break number 2, the senior bonus deduction. This one is brand new, and many tax preparers are not yet applying it automatically. The One Big Beautiful Bill Act, signed on July 4, 2025, created an entirely new deduction for Americans aged 65 and older. It is called the Senior Bonus Deduction. If you are 65 or older, you can deduct an additional $6,000 from your taxable income on top of everything described above. If you are married and both spouses are 65 or older, that doubles to $12,000 combined. This deduction is notable because you can claim it whether you take the standard deduction or itemize. That matters because most people on fixed incomes do not itemize. This applies broadly. The income limits are $75,000 for single filers and $150,000 for married couples filing jointly. Below those thresholds, you receive the full deduction. Above them, it phases out gradually. It is claimed on the new Schedule 1A attached to your Form 1040 or Form 1040-SR. It is available for tax years 2025 through 2028 only. Let me show you what these first 2 deductions look like together for a typical retiree. Take a married couple, both age 66, both on Social Security, and a pension, with modified adjusted gross income around $80,000. Their base standard deduction in 2026 is $32,200. Add the additional senior deduction for both spouses, $3,300. Add the new senior bonus deduction, $12,000. Their total deduction before a single dollar of income is taxed is $47,500. $500. For a couple with modest retirement income, that alone could eliminate most or all of their federal tax bill. The IRS itself issued a notice that not all tax software is applying this deduction automatically. If you already filed your 2025 return without it, you can amend within 3 years using Form 1040X. Tax break number 3, the qualified charitable distribution. This one is not a deduction. It operates differently, and in some situations, more effectively than a deduction. If you are 70 and a half years old or older and you have a traditional IRA, you can transfer money directly from your IRA to a qualifying charity. That transfer is called a qualified charitable distribution, or QCD. The money never passes through your bank account. It goes directly from your IRA custodian to the charity. The amount you transfer does not count as taxable income at all. It does not appear in your adjusted gross income. It does not cause more of your Social Security to become taxable. It does not trigger IRMA Medicare surcharge adjustments in 2026. You can transfer up to $111,000 per person this way. If your spouse also has their own IRA, they can transfer another $111,000. And the QCD counts toward your required minimum distribution for the year. Here is a straightforward example of why this matters. Carol is 74 years old. She lives alone in Georgia. She has a traditional IRA and is required to take out roughly $14,000 this year as her required minimum distribution. She also donates $2,000 a year to her church. If Carol takes her full $14,000 RMD into her bank account and then writes a check to the church, the entire $14,000 is taxable income on her return. Her Social Security taxation increases. Her Medicare premiums could rise 2 years later. But if Carol arranges a qualified charitable distribution of $2,000 directly to the church from her IRA before December 31st, that $2,000 is excluded from her taxable income entirely. She satisfies $2,000 of her required minimum distribution. The church receives exactly the same donation, and Carol's taxable income is $2,000 lower. At her tax rate, that saves her real money. If she were near one of the Social Security taxation thresholds, the savings could be significantly larger by keeping more of her benefits untaxed. The one mistake retirees make with QCDs is waiting until after they have already withdrawn the money. Once you take the RMD into your bank account, it is too late. The distribution is already taxable. The QCD must be sent directly from the IRA custodian to the charity. Call your broker or custodian and ask specifically for a QCD distribution form. Most major custodians, Fidelity, Vanguard, Schwab, now allow you to do this online or will mail a check directly to the charity on your behalf. The deadline is December 31st, not April 15th. If you are planning to use a QCD to satisfy any part of your required minimum distribution for the year, the transfer must happen before December 31st. Tax break number 4, the medical expense deduction. Retirees are the single group in America most likely to benefit from this deduction, and most of them never claim it because they assume they do not itemize. Here is how it works. If your total unreimbursed medical expenses in a year exceed 7.5% of your adjusted gross income, you can deduct the portion above that threshold when you itemize on Schedule A. That 7.5% threshold is permanent law as of 2021. What counts as a medical expense is broader than most retirees realize. Medicare Part B premiums count. Medicare Part D premiums count. Medicare supplemental insurance and Medigap policies count. Long-term care insurance premiums count, up to certain age-based limits. For someone aged 71 or older in 2026, the deductible limit on long-term care premiums is approximately $5,640 per person. Dental work counts. Hearing aids count. Vision exams and prescription eyewear count. Modifications to your home made for medical reasons, grab bars, wheelchair ramps, stair lifts count. Even mileage driven to and from medical appointments counts at 21 cents per mile for 2025. Here is why this matters specifically for retirees. If you have a pension of $45,000 and Social Security of $20,000, your AGI might be around $50,000. 7.5% of $50,000 is $3,750. Now consider what a retiree on Medicare actually spends in a year. Medicare Part B premiums in 2026 are $2,134 per person annually. Add a Medicare Part D plan, add a Medigap supplemental policy. For many retirees, that alone is $5,000 to $6,000 before a single doctor visit or prescription. Add one dental procedure. Add hearing aids, which Medicare does not cover and which can cost thousands of dollars out of pocket. Add prescription copays. By the time you add it all up, a retiree with modest income on Medicare is often much closer to that 7.5% threshold than they realize. And every dollar above it becomes a deduction that the standard deduction never provided. With the new senior bonus deduction adding up to $12,000 for a qualifying couple, the bar for itemizing is higher than it used to be. But if you have significant medical costs, you should run both scenarios every single year before you file. Tax break number 5, the credit for the elderly or disabled. This is the most overlooked item on this entire list. It has existed in the tax code for decades. It applies to many retirees right now, and the majority of the people who qualify for it have never seen it on their return. Here is how it works. If you are 65 or older, or if you are under 65, retired on permanent and total disability, and have taxable disability income, you may qualify for a non-refundable tax credit worth between $3,750 and $7,500. Not a deduction, a credit. A dollar-for-dollar reduction in what you owe. The income limits are narrow. For single filers in 2026, your adjusted gross income must be below $17,500. For married couples filing jointly where both spouses qualify, the limit is $25,000. These are modest thresholds. This credit is designed for retirees with lower incomes who are still paying some federal tax. But consider who that describes. A retired school teacher living on a modest pension and Social Security. A widowed postal worker whose income dropped significantly after her husband passed. A retiree living primarily on Social Security with a small IRA distribution. These are the exact people this credit was built for, and in most cases, their preparer either does not know the credit exists or assumes the income is too high without ever actually running the calculation. The credit is calculated on Schedule R and transferred to Schedule 3 on your Form 1040. The IRS will calculate it for you if you fill in the right information and check the appropriate box in Part 1 of Schedule R. You do not have to do the math yourself. If you are in the income range where this credit applies, it can eliminate your entire federal tax liability for the year. Let me bring this back to Barbara. Barbara in Ohio. 28 years at the post office. $900 owed last April that she should not have owed. Here is what was missing from her return. The additional standard deduction for age 65, $1,250, not on the return. The new senior bonus deduction, $6,000, not on the return. Medicare Part B and D premiums she had been paying all year, over $3,000, which combined with her other medical costs would have pushed her over the 7.5% threshold and made itemizing worth examining, never discussed. And the credit for the elderly or disabled, which at her income level would have applied, never checked. None of these required her to do anything unusual. None of them required a complicated strategy, a financial advisor, or an attorney. They required someone who knew to look for them. The difference between a retiree who receives every dollar they are entitled to and one who sends extra money to the IRS every April is not wealth or complexity. It is knowing what to look for and having someone who checks. Here is your action checklist. 5 steps before you file or amend. Step 1. Pull out your 2025 tax return. Check line 12 on your Form 1040. Verify that the age 65 or older box is checked. If you or your spouse are legally blind, verify that box is also checked. Step 2. Look for Schedule 1A attached to your return. If it is not there and you were 65 or older in 2025 with modified adjusted gross income under $75,000 single or $150,000 joint, speak with a tax professional about filing an amended return using Form 1040X. Step 3. If you are 70 and a half or older, have a traditional IRA, and give to charity, call your IRA custodian and ask about setting up qualified charitable distributions before your next RMD deadline. Step 4. Add up everything you spent on Medicare premiums, supplemental insurance, dental, vision, hearing, prescriptions, and medical-related mileage this year. Divide your expected AGI by 13.3. If your medical costs are anywhere near that number, run both scenarios, standard deduction and itemized, before you file. Step 5. If your adjusted gross income is under $1,700 as a single filer or $25,000 as a married couple, ask your preparer specifically about Schedule R and the credit for the elderly or disabled. If they are not familiar with it, find someone who is. Barbara filed an amended return. She received $840 back. It took one conversation with someone who knew what to look for. This is Senior USA Guide. If this video helped you identify something your preparer may have missed, hit the like button and subscribe so you do not miss future videos. Share this with any retiree you know who is over 65 and files their own taxes or works with a preparer who has never brought up any of these 5 items. Tell me in the comments, which of these 5 did you already know about and which one was new to you? I read every comment, and the questions and situations that come up most often become the topics for future videos.